Think setting up that LLC protects you? Think again. Hi, I'm Sherry Ayland, CPA and tax advisor, and I help my clients pay little to no taxes using real estate tax strategies, including how to structure your business properly and make sure you're running it correctly. In our last video, we talked about choosing the right entity structure, your operating company, your asset holding companies, and maybe electing an S Corp status. And yes, those structures are powerful. They can reduce taxes, limit liability, create separation, and protect assets. But here's the part most people miss. Forming the entity, that's the easy part. Operating it correctly is what actually protects you. And if you don't operate it correctly, a court can ignore it. The IRS can challenge it, and your protection can disappear. So today, I'm going to walk you through the key principles you must follow to maximize liability protection, audit defense, and long-term tax strategy. And we're going to go through this step by step. So the first step is respecting the entity as a separate business. The LLC is not you. It's a separate legal person or entity. And that means separate bank accounts, separate credit cards, separate bookkeeping, no commingling of funds, and no paying personal expenses from the business. Here's a simple example. You swipe your business card for groceries, a family vacation, or your kid's soccer registration. And you tell yourself, I'll sort it out later. In court, behavior shows that you are not treating the LLC as a separate entity. And that's how the corporate veil gets pierced. Now, from a tax perspective, if your books are full of personal expenses, the IRS doesn't just disallow those deductions, they start looking deeper. Sloppy separation signals sloppy compliance. If you want protection, you must behave like a real business owner. Step 2 is following corporate formalities, even if you're the only owner. A lot of people think, I'm the only member, I don't need meetings. You do. And that means you need documentation. That includes an operating agreement, annual meeting notes, written resolutions for major decisions, and documentations of elections. For example, let's say you elect S Corp status, you buy a $90,000 truck, or you take out a loan, or you bring on a partner. If none of this is documented properly, you look disorganized and informal. Courts respect documented businesses, and the IRS respects documented businesses. Even if you are the only owner, document decisions. It shows you respect the structure. Now, one of the strategies that we use for our clients is even if you're just an LLC owner, you're not taxed as an S Corp, you can still have a board of advisors versus a board of directors for an S Corp and have annual meetings with those. And those can become tax write-offs. You not only have a tax write-off, but you document what you plan on doing for the next year at a minimum. You can also do this quarterly, but definitely every year. And it gives people the opportunity to give you feedback, to involve your family, and those kind of things in planning for your business. Now, step 3, be sure and pay yourself properly, especially for S Corps. This is where people get aggressive and get in trouble. If you elected S Corp status, you must pay yourself reasonable compensation, run real payroll, file payroll reports, and pay your payroll taxes on time. Here's what I see all the time. An owner makes $200,000, takes 0 payroll, pulls everything out as distributions. That is a red flag when it comes to an S Corp. The IRS will reclassify those distributions as wages. Then they can assess back payroll taxes, penalties, and interest, and it adds up fast. On the other hand, if you run clean payroll, document your reasonable compensation, and structure distributions properly, the S Corp becomes powerful and defensible. The key word is defensible. Step number 4, keep clean, defensible books. This starts with your bookkeeping. You need monthly reconciliations, clean categorization of expenses, receipts for large deductions, mileage logs, and asset schedules. Now let's talk about monthly reconciliations for a moment. If you don't reconcile your bank account every month, Then what if QuickBooks or whichever accounting software you use for some reason didn't pull in a $30,000 expense transaction? Well, you just lost a $30,000 deduction. So we want to make sure we have clean, up-to-date books. We also want to do that in order to be able to properly plan for taxes, because if you don't know how much money you've made, you don't know how much you need to find to write off. Now, here's another example. Let's say you deduct $38,000 in meal and travel expenses, and the IRS asks you, show me the documentation. And you say, it's in my bank statement somewhere. Well, that deduction is likely gone. But if you produce receipts, notes, a mileage log, and clean books, now the audit becomes more of a review, not a big battle. Good bookkeeping is audit insurance, and it protects both your deductions and your credibility. Step 5, clearly define loans, contributions, and distributions. This one quietly causes huge problems. Money moves between you and your business, but what is it? Is it a loan? Is it a capital contribution? Is it a distribution? Each one has different tax treatment. For example, you put $50,000 into your business. If it's a loan, it must be documented with terms, including the interest rate and how long the loan is for. If it's a capital contribution, it increases your basis. If it's undocumented, it creates confusion. Later, you take $50,000 out. Was it a repayment of a loan? Was it a distribution? Was it taxable? Without documentation, you can accidentally create taxable income. Clear documentation protects your basis, your deductions, and your tax strategy. Step 6, maintaining proper insurance. An LLC is not a substitute for insurance. It is one layer. Insurance is another layer. You should review your general liability, professional liability if this applies, umbrella coverage, property insurance, and even cyber liability. For example, let's say your operating company gets sued. If you have a separate asset holding company, proper leases between those entities, and insurance coverage, now you have multiple layers protecting you. Protection should never rely on one strategy. It should be layered. Step 7, separate operations from assets. Now, we talked before, operating businesses create risk. They interact with customers, vendors, employees, and contracts, and risk lives there. If your operating company owns valuable real estate directly and it gets sued, that asset is exposed. A cleaner structure would be the operating entity runs the business, the asset entity owns the property, and the operating business leases the property from the asset entity. And yes, that lease should be documented. It should also be at market rates. That separation is what creates real protection. Step number 8, stay current on compliance. Now, this sounds boring, but it's not. You must file annual reports, pay franchise taxes if applicable, maintain a registered agent, file tax returns on time, and keep the entity active. If your entity gets administratively dissolved, then your liability shield can disappear. And you don't want to discover that after a lawsuit begins. Compliance is maintenance, and maintenance preserves protection. Now, one of the biggest things I see, a lot of people will create LLCs, and they don't understand that you have to renew that LLC with the state, usually every year. It depends on the state. And if you don't do that, then you get administratively dissolved or suspended, or it just expires. So you have to make sure you keep that up to date. And before a bank will loan you money, they're going to check and make sure you're active in that state. So let's recap what we've talked about. Setting up the LLC is step 1. Operating it correctly is what actually protects you. Courts look at behavior, IRS looks at documentation. Protection comes from separation, discipline, documentation, clean books, proper payroll, and a layered structure. This is why entity strategy is not just about tax savings. It's about asset protection, audit defense, and long-term business stability. If you've already set up your entity, but you're not sure you're operating it correctly or have questions on how to do it better, then check out the link below and book a discovery call, or check out the link to the LLC protection and audit defense checklist below.